Why do we always hear that investing into index funds is the best route to go for average investors? Basically, index funds is the easiest way for you to become a millionaire with minimal effort. Even Warren Buffett recommends that most investors should just buy and hold index funds for the long term because a majority of investors will not be able to consistently pick stocks that can outperform the market over the long term. In today's video, I will be covering some of the best index funds, why you should be investing into index funds, and the best index fund investing strategy. Almost everyone loves investing into index funds, and for very good reason. They're easy, require minimal effort, they're diversified, and they are a low-cost way to invest into the stock market. Index funds have also historically given some of the best returns, and they do better than 99% of investors who pick their own stocks. I really believe in this strategy, and I even invest this way myself. I also have evidence that backs up my claims, and to show you guys that statistically, this would be one of the best investment routes to go. So what are index funds? They basically come in the form of exchange traded funds / ETFs that track an index. Depending on which index the ETF is supposed to track, it will just basically buy the same investments of that index, which means that there's no fund manager actively trying to pick the best investments. It's basically a computer doing most of the work, and its performance will be very similar to the index that it is tracking. This would make you a very small percentage owner of all of these companies that will give you an average return based on every single stock within that index. That is basically an index fund. With index funds, you don't have to do any of the hard work. You don't have to study anything. They're very affordable, and you get instant diversification into all of these companies with just one single purchase. So here's why this is very important. Instead of you having all your eggs in one basket, as you would by investing into a single stock, you'll have ownership in a wide variety. So if one stock crashes, it won't really hurt you as much because all of these stocks will only be a very small portion of your entire portfolio. Index funds and ETFs would be the easiest way for you to make a lot of money if you consistently invest over the long term. And as much as I love picking my own stocks, the truth is that over the next 10 to 20 years, most investors would be better off just investing into an index fund that tracks a wide variety of the stock market because it is really hard to consistently pick stocks that will beat the market over the long term. 95% of finance professionals can't even do it, and I'm no professional, and no offense, I'm sure you aren't either, but if financial analysts can't even win at their own game, what makes you think that you and I would be able to? The easiest method, in my opinion, would be to dollar cost average into index funds, which means that you set aside a certain amount to invest into these index funds every time you get paid, or every week, or every month. So let me put it into this perspective. If you start investing $500 at around the age of 20 with an average annual return of 8% per year, in 35 years, you will have over $1 million. And I already know what a bunch of you guys are gonna say. 35 years is way too long for me to become a millionaire. I want to be rich now. Well, look, if you want to become a millionaire in about half of the time, instead of the original 35 years, you are going to have to invest more than 5 times as much as the original amount, $2,500 per month for 17 years at an average return of 8% per year to get to the same goal of $1 million. This is why the sooner you start investing, the better. The first ETF that I really like here and have included in my own personal portfolio is the SPDR S&P 500 ETF Trust, ticker symbol SPY. This is the king of ETFs, and it was started back in 1993. This ETF really helped kick off the trend of ETF investing that has become so popular today, and as of August 2020, this had over $287 billion in assets, ranking it among the most popular ETFs. This is an ETF that tracks the performance of the S&P 500, so with one single share, you own a small portion of all of the top 500 publicly traded companies in the United States for around $340 per share. So by owning one of these shares, you will have spread all of your $340 across all 500 of these companies literally. literally. If you're looking to invest into a little bit of a lower cost index fund that will give you almost identical results to the S&P 500, some alternatives are the Vanguard S&P 500 ETF, ticker symbol VOO, the Schwab S&P 500 Index Fund, ticker symbol SWPPX, and the iShares Core S&P 500 ETF, ticker symbol IVV. This is my personal favorite index because within this index, there's tons of great companies that you might want to invest within individually, such as Apple, Amazon, Google, Microsoft, and tons of others, but you might not have enough money to invest into a single share of a company like Amazon that is trading for over $3,000 per share. So instead, when you buy one of these ETFs, you will own a small portion of all of these companies along with 496 other great companies. These are some of the best S&P 500 index funds that allow investors to enjoy stocks of the S&P 500 at a lower cost with the benefits of having diversification and lower risk. And with these benefits, it's no surprise that these are some of the largest funds on the market. There's index funds for many different types of markets, and the next two that I want to look at are Vanguard funds. The first one is the Vanguard Total World Stock ETF, ticker symbol VT, and the next one is the Vanguard Total US Stock Market ETF, ticker symbol VTI. VT, which is the Vanguard Total World Stock ETF, allows you to own every single stock in the entire world with just one ETF purchase. It tracks an index that measures the performance of the return of stocks of companies located in the developed and emerging markets around the entire world. There are many professional investors that advise diversifying into international markets as well, and for some pretty good reasons. There are problems within individual countries. Over the past 10 years, there's been times where investors have had their wealth completely wiped out just because they invested in an individual country, and there was issues such as debt crises, monetary reforms, the bursting of bubbles, and meanwhile, during all of this, markets in other countries continue to thrive. The second reason here is that one single country cannot outperform others. One single country never outperforms because if one country did outperform, that can lead to overvaluation and then a sell-off. So being geographically diverse has big upside and little downside for investors. VTI obviously holds only US stocks, but VT holds stocks from all over the world, and you can really see the diversity of VT when looking at this pie chart from Vanguard that shows the portfolio composition of the index. We can see that VT is mainly composed of US stocks, making up 55% of the index, and the other 45% is made up of international stocks. What's very interesting to take note of is that the top 10 holdings from each fund are nearly identical, simply because most of the largest stocks in the world are from the United States, with Apple, Microsoft, Amazon, Google, and Facebook making up the top 5. So just like I said earlier, investing into these two indexes would give you such awesome diversification into these big companies whose shares trade at very high amounts. Now, with VTI, the Vanguard Total US Stock Market ETF, this is a great choice for US investors that are looking for a simple index fund that maximizes diversification and minimizes fees. This ETF holds over 3,600 publicly traded stocks in the US. The last ETF that I would recommend you add to your portfolio is some sort of bond ETF. A bond ETF is pretty self-explanatory. It's an ETF that exclusively invests into bonds. So now between these two index funds, which would be the better one to invest in? Here's what I personally do. I like to invest in both a mix of VT and VTI, but just keep this in mind. The more VTI you add to your portfolio, you are increasing your bet that US stocks will outperform international stocks in the future. This may or may not happen, but either way, if you own a balance of both, you won't really care because you'll own a little bit of everything. So even if US stocks do decline for some time, you will still see the gains of the international markets. They're very similar to bond mutual funds because they hold a portfolio of bonds with different particular strategies, from US treasuries to high yield, and different holding periods from short term to long term. Sounds super boring, right? So what I would recommend doing is just buying some sort of bond ETF, like the Vanguard Total Bond Market ETF. For those of you that don't know how bonds work, they're issued by governments and corporations when they want to raise money. So to put it really simple, when you buy a bond, you're giving the issuer a loan, and they agree to pay you back the face value of that loan later down the road on a specific date. They also will be giving you periodic payments along the way, usually twice a year. Even though bonds have recently been doing worse than stocks over the past few years, you always want to make sure that you have some type of exposure to the bond market, because when stocks are not performing the way you want them to, this is when the bonds can really step up and take some charge within your portfolio. Since Warren Buffett preaches about investing into index funds, I'd probably take some advice from the guy, since he's one of the best investors ever, and I'm pretty sure he knows a thing or two about investing. Not to mention that stock market investing has made him a multi-billionaire, so you would obviously want to learn from the best. Now here's how you can put these three types of ETFs together. My favorite method of doing this is building what is called the 3-fund portfolio. This is the most popular strategy when it comes to investing into index funds, and it will beat 99% of investors who pick their own stocks over the long term. So first off, you want to start with buying a US stock market index. I personally own SPY and VOO. You want this to make up around 65 to 70% of your entire portfolio. Next off, you want to add an international stock index for extra diversification. I own VT, the Vanguard Total World Stock ETF. This would be good at around 20% of your portfolio. Lastly, for number 3, add some type of bond index. In this case, I like the Vanguard Total Bond ETF or the iShares 20+ year Treasury Bond ETF. You want this being the smallest position at around 10% of your portfolio. And this is all you have to do. You don't have to buy these exact ones. These are ones that I just personally like and own myself. By owning these 3 types, you will give yourself maximum diversification at the lowest cost, and not to mention that you will give yourself the best return than you going out and trying to pick stocks on your own. Doing this, you will have money spread across 3 different types of markets, so if something happens to one of them, you will still have 2 others that are performing well. This method is super simple and very easy. I just buy these 3 funds every single month and just buy, reinvest, buy, and reinvest again. It's that simple, and I just continue to hold these 3 funds for the long term. For most people, this will be a way better investment strategy than anything you could ever do for yourself. By doing this, it will make sure that you are consistently performing at market averages every single year. And I already know there's gonna be some people in the comment section saying things like, well, dude, I bought Tesla at $1,000 per share and I've already doubled my money since then. But yeah, good luck trying to do that consistently every single year, because only about 1% of finance professionals can even do it consistently. Look, don't try to time the market. It will not work 99% of the time. The market is sitting at all-time highs right now, but that doesn't mean it can't go higher. I'm not saying it will, but you just don't want to be that person who's sitting on the sidelines waiting for the stock market to go lower, because you might be waiting forever. Go into this with a long-term outlook, because historically, over the next 10 to 20 years, the stock market will only continue to go higher and higher. Even just a few months ago, everybody thought that it was the stock market apocalypse and that it was going to take the stock market years to recover, and boom, 6 months later and we're back at all-time highs. So you never really know what's gonna happen, and it's really funny because everyone always tries to take back what they said when things were looking bad, like I never said the market was gonna get worse. And if for whatever reason, some misfortune were to go and happen and the stock market were to crash, I don't wanna say that, I don't wanna say that too loud, knock on wood, but that would only create an even better buying opportunity. There's been tons of research that has shown that time in the market will always end up beating timing the market. And in a study from Charles Schwab, 74% of the time, you are better off investing right now and holding over the next 20 years than you trying to wait for the stock market to go lower. Not even the top finance analysts even know what's gonna happen with the markets in the short term. So why even try? I always just invest as much money as I can every single month into these index funds with a mentality of holding them for over the next 15 to 20 years, and statistically, I should come out ahead. This is my first video in like 10 days. I know I've been slacking a little bit, but that's just because school started up recently, so I've been a little busy with that, but I will be posting more consistently, 2 to 3 videos a week, since I'm nearing 1,000 subscribers, which is so awesome. But please make sure to comment something down below, DM me on Instagram or something. Just keep bugging me about posting more content. I really hope you guys enjoyed today's video. Make sure to smash that like button and hit that subscribe button for your boy. I'll catch you guys in the next video. Peace.